On.
Hey,
Welcome everyone to Spark Rentals, Facebook Live, podcast, YouTube, you name it.
all the above.
Yes. Thanks for tuning in, and please just throw in the comments where you're joining us from. Let us know how you're
Questions,
doing.
bad jokes.
Oh, jokes are good. Bad and good. My husband tells lots of bad ones.
It's a husband's prerogative.
Yes, he's a dad joke king, we call him. So we're gonna look, we all know that the housing market's been like crazy, and then the speculation's even crazier. So we're gonna talk today about how to not worry about it so much. So 6 ways to protect yourself even during housing market corrections. So it is possible to invest and be successful in any housing market. So with
Absolutely.
that being said, start us off, Brian. Like, what are some things that people can do, look out for, whatnot?
Sure. Well, yeah, I mean, this is a good moment to have this conversation because during the pandemic and in the immediate aftermath of the pandemic, so the housing markets just shot upward from mid 2020 through mid 2022. Some markets saw like 70% appreciation in that time, some even more than that. So it was just goofy. There was a little like bubbly, right? It had the feel of a real estate bubble. And then in mid 2022, housing markets started cooling because that kind of growth was not justified by some of the economic fundamentals in those cities. So there's been a correction since mid 2022, which has all the pundits, putting the headlines out there, trying to put the fear of God into people, right? Because fear and alarm sells as a headline, right? So if you read the newspaper, or what do people read these days? I don't know, blogs,
Yeah, I know. I don't think
podcasts,
newspapers are.
TV, radio, whatever. All the pundits are out there talking about how real estate's a total mess right now, how housing markets are crashing left and right, and it is true that there are some markets, in fact, there are hundreds of cities that have seen home prices decline over the last quarter, and in some cases since mid 2022. So it's not that housing corrections never happen, and it's not even that we're not in one right now, because many markets, I mean, all real estate is local, of course. Some markets are doing just fine and still appreciating, but some are correcting right now, and that is part of the normal real estate market cycle. It's really part of any market cycle,
Yeah.
right? So that's just how it goes. That's what happens in stock markets, albeit in much more volatile and extreme ways in stock markets. Real estate markets are much calmer and less volatile than stock markets, which is exactly why people invest in it. One of the many reasons why people invest in real estate is that it is a hedge against stock market crashes.
Hmm.
Stock markets correct and crash and shoot upward all the time. It bounces all over the place. So a lot of investors also invest in real estate to protect against some of that volatility in stock markets. So keep that in mind first and foremost, that real estate markets are much more stable than stock markets. Even when they have a correction like we're seeing right now, it's still much less volatile than stock markets. So
And you definitely would say diversification. So this doesn't mean get all your money out of the stock market and put it in the real estate market.
no, not at
It,
all. No, a healthy portfolio has a mix of stocks and real estate, and maybe bonds if you're older, maybe alternative assets. And within each of those buckets, you should have a bunch of diversification too, right? Your stock market portfolio should include U.S. stocks and international stocks and small cap stocks, mid cap stocks, large cap stocks, stocks in the technology sector, stocks in the retail sector, whatever. You want
in the
massive,
weed
yeah,
sector at this point.
right? Pot stocks, sure. If you don't mind some extra volatility there, but yeah, diversification is how you protect against a crash in any one sector, right? So anyway, that's the high level view. Let's drill down to how you can protect your real estate portfolio from corrections from downturns in the market, which do happen occasionally, not nearly as often in real estate as in stocks, but it does happen as we just outlined. So, 6 things you can do to protect your real estate holdings against downturns. First of all, first thing you can do is invest for cash flow and not count on or assume appreciation, right? Appreciation normally happens. It's great. Over time, real estate does appreciate because there are more people trying to share the same amount of land, right? So yes, values do go up over time typically, but cash flow is much more stable because rents almost never decline. And they don't ever decline on a nationwide level, even during recessions. So home prices do often dip during recessions. Rents, at worst, they just flatline for a year or two. But even during the Great Recession, when home prices nationwide crashed 25 to 30%, rents just flatlined. So if you invest for cash flow, you inherently get much more stable returns that way. And yeah, appreciation will probably happen, but don't assume on it happening, right? Don't count on it happening. All right, number 2, invest in solid, stable neighborhoods. Do not invest in super low end war zone neighborhoods. And you can also be careful about investing in super high end neighborhoods because the margins, the profit margins in super high end neighborhoods tend to be pretty thin. So there's not much margin for error there. But solid middle class neighborhoods, those tend to be much more stable cash flow wise. So that's second tip here as you invest for cash flow. Number 3, you can consider investing in affordable housing, but be selective about it, right? So instead of investing in those war zones, like we mentioned a minute ago, you can invest in things like mobile home parks. It's the ultimate affordable housing. And when you invest in a mobile home park, the park doesn't necessarily own the actual mobile homes. They rent the pads. So it's easier to manage a mobile home park with just pads. It's easier to evict people from those pads, and so on and so forth. So it's another option on the table, and we'll talk in a few minutes about some very easy and low cost ways to invest in mobile home parks if you're interested. All right, number 4 is screen the heck out of your tenants. Denny, you and I have talked about this many times.
And it surprises me still that people sometimes don't even. They just take people at their word and everything else. So
yeah, so screening tenants is not just a matter of running reports, although you should do that. We offer that in our property management software, and we'll put a link to it in the comments. But it goes beyond just running credit reports, criminal reports, eviction history reports on applicants. You need to call up their current and former landlords. You need to call up their employer, their supervisor. What kind of worker are they? Are they reliable? Do they show up on time every day? What's their likelihood of continued employment? You ask their landlord, do they pay the rent on time? How do they treat the property?
Drive by if you can. Drive
yeah.
by and see what that's such a clue. The outside of the property.
And inside if you can get inside.
Yeah.
As well. But the bottom line here is that stable and reliable tenants lead to stable and reliable rental income. So screen the heck out of your tenants. Only put the best of the best tenants in your units. All right, number 5, insure against rent defaults. You can buy insurance policies every year that guarantee that you'll collect the rents for every month. So if the tenant stops paying, you file a claim with the insurance, they kick in and they pay you the rent until you find a replacement tenant. So that is a very simple and easy way to protect yourself against market downturns and just to protect your cash flow.
True. I mean, we protect the stuff, we protect the building. Why not protect the income? Exactly.
And we'll put a link to where you can find those kinds of insurance policies as well in the comments here. All right, number 6, invest in self-storage facilities because people need places to store their stuff in both good markets and in bad markets. So in good markets, people are buying lots of stuff, buying bigger homes, but maybe they don't have, maybe they haven't moved into the bigger home yet. So in good markets, people need places to store all their stuff. In bad markets, people downsize. So what do they do with all their extra stuff that they can't fit into their new, smaller home? They put it in
True.
storage. So,
It's crazy because during COVID, office space was not where to go because everybody
yeah,
was just starting to work from home and they were leaving office space. But storage facilities, they actually some of them didn't have space. They were going nuts.
oh
So
yeah,
yeah.
yeah. Self-storage facilities are a really nice hedge against recessions. You can never say recession-proof investments, but these are a perfect example of recession-resistant investments. It's like the closest you can get to a recession-proof investment. And finally, number 7, a bonus tip or how to actually invest in things like self-storage facilities, mobile home parks, is invest in real estate syndications. These are commercial properties where you buy in as a fractional owner so that you don't have to actually go out and spend $1 million or $2 million or $3 million on an entire self-storage facility or an entire mobile home park or whatever. You just buy in as a fractional owner. And we have an investment club that every month, this is what we do. We pick a deal and we invest in it as a club so that each person's minimum investment is much, much lower than the normal minimum investment for these, which is comparable to like a down payment on a rental property. So,
Right.
uh, yeah, the normal minimum investment for a real estate syndication is like 50 grand, 100 grand. Most of us don't have that lying around. But in our investment club, we dropped that down to 5 grand, which is way easier than coming up with a down payment or investing in a real estate syndication by
And you
yourself.
can invest in multiple deals. So if one doesn't do well, the other one might. Do you know what I
Exactly.
mean? So it's
Which ties us back to diversification, right? We've come full circle with the diversification. And we'll put a link in the comments as well to where you can check out real estate syndications and our investment club, if you're interested in doing that and joining us. So, Danny, what did I miss? Anything that you want to add here before we call this episode complete?
No, I think you covered it all. I just want to add one thing that you always say, but never, you can't just, we can't time the market. So don't even try anymore to do that. I mean, that never works either, just as a warning.
It's a fool's game. Have some humility. People that are way smarter and better informed than you, whose job it is to analyze these huge reams of data and analyze the market, they can't time the market accurately. And if they can't do it, you can't do it.
No.
So, humility. And as a final thought, we talked in the beginning of this episode about some cities around the country that are seeing a housing market correction right now. We have an interactive map of what those cities are, the cities that do have home prices that have declined quarter over quarter. We'll put a link to that interactive map as well if you're curious about checking that out.
Absolutely.
All right. On that note, we will part ways until next Tuesday.
Next week.
Stay in touch. Hit us up at support@sparkrental.com, what you want to hear more about. And please, if you enjoy these broadcasts, the YouTube and the Facebook Lives and the podcast, we release this in all kinds of different formats. But if you enjoy these, please, like the show, like the episodes, share them with your friends who might be interested in this. Leave positive reviews on things like
Yes.
iTunes and Stitcher and so forth. All right.
All
Thank you,
right.
guys.
Thank you. Have a great day.
We'll see you next week.